Hi, I'm Santiago Giraldo, Chief Financial Officer for Tecnoglass Inc. I'm here to discuss the second quarter results for 2020. To give you a little bit of perspective, at the beginning of the quarter, and actually toward the end of the first quarter, the Colombian government put in place a shelter in place order that lasted about 3 weeks for us, so into the middle of April. So we were able to only invoice the second half of April and then May and June. So our revenues were impacted by not being able to operate during that time, but we were able to basically put in place secure measures and sanitary measures to work properly and resume activities at 100% after that. Despite having lower revenues quarter over quarter, the company achieved record gross margins, record operating margins, and record EBITDA margins. From a gross margin perspective, we were able to do that based on a couple of factors. Lower input costs, mainly lower raw aluminum. We were able to do that by having completed our automation process, which we completed in Q1 of this year, and that has substantial structural benefits moving forward related to lower waste costs, especially in glass, lower wages because we're actually having less headcount and less energy cost. So those are some structural and sustainable advantages that should allow us to keep margins at a higher level year over year. So we were able to achieve gross margins at a record 38.8%, roughly up 500 basis points from last year, which was fairly impressive. From an SG&A perspective, we were able to reduce cost by $4 million year over year. Some of that attributed to less variable costs as we had less revenues year over year. But some of it also through efficiencies, obviously less traveling expenses, and some other things that were put in place during the period. So as a result, we were able to achieve record operating margins at 18.6%, which was substantially better than last year, despite the fact that, again, we had less invoicing time during this quarter. From a tendency perspective, July is looking better than June. Sequentially, June was better than May, and May was obviously better than April, which has only 2 weeks. So moving forward for the rest of the year, our expectation is that from a top line basis, we're going to continue growing and having full quarters of invoicing Q3 and sequentially better Q4. From a cash flow perspective, this quarter we ended up doing $24 million of cash flow from operation, which is a record level, and ended up with approximately $17 million in free cash flow. As I had mentioned earlier, we had completed a growth CapEx phase related to automation, and that has been completed. So our expectation for the rest of the year is for CapEx to be limited, perhaps a couple $1 million for what is left of the year. So our expectation is that from a cash flow perspective, we will not only generate incremental cash flow from operation, but also cash flow, free cash flow. Touching a little bit on what's going on in the markets, which I know that is on everybody's mind, given everything that is going on. What we're seeing in our two different segments is different. On the residential side, which we have grown from $7 million in 2017 to about $70 million this year, so we've amplified that by 10 times, we continue to see incremental business. We saw record orders in June, and then subsequently we saw record orders in July. And those orders are expected to be invoiced in Q3 and Q4 of this year. So that business continues to do very well. And I think that's in part in line with everything that's going on in an industry with new housing starts, remodeling, and whatnot. On the commercial side, we basically have our backlog that we are executing for the rest of the year. In our business, lead times tend to be 12, 18 months out. So basically what we're executing today are things that were put into our backlog 12 months ago. So basically our expectation is that we will continue to execute on that backlog for the rest of the year and well into 2021. Our backlog level ended up at $550 million 4.8% up year over year. Despite everything that is taking place, what we are seeing in our end markets is that both developers and general contractors want to continue, want to move forward with projects. And I think if we can kind of clear the last hurdle, which is obtaining financial closings, we're going to see a ramp up in activity again. So, we have a good view for the future going forward. Specific to markets, we're seeing, good trends in the Northeast. Florida has obviously been impacted by higher COVID cases, but we're not seeing a tremendous amount of impacts in that respect, specifically in the segment of rentals and lower buildings, a little bit more so on high-end condos and large buildings. But again, what we expect going forward is that as things normalize, economies continue to open, and conditions for lending become more available to our clients, we expect a rebound in that front. All in all, a very good quarter, despite the challenges at the beginning of the quarter in April of having 2 less weeks of invoicing, able to achieve record gross margins, gross profit margins, record operating margins, record EBITDA margins, a healthy amount of cash flow. So, what we see over the next couple of quarters is really consistent with what we're seeing right now in terms of margins and operating cash flow. And with that, I conclude my presentation.